Profitability serves as the heartbeat of any thriving business, fueling its growth and ensuring long-term success. Companies strive to generate revenues that not only cover their expenses but also leave room for substantial profits. One of the fundamental metrics that sheds light on a company's financial health is the profit margin. Understanding and effectively managing profit margins can make a significant difference in the long-term viability and competitiveness of a business. In this video, we'll delve into the concept of profit margin and explore why it holds such importance in the business landscape.
By the way, if you like this type of content, be sure to hit the like and subscribe button.
What is profit margin? Profit margin is a financial metric that measures the profitability of a company or a product by calculating the percentage of profit generated from its revenue. It is a common indicator used by businesses and investors to assess the financial performance and efficiency of a company's operations. A higher profit margin indicates that a company is able to generate more profit per dollar of revenue, which suggests better financial health and efficiency. On the other hand, a lower profit margin may indicate lower profitability or higher costs relative to revenue. Types of profit margin. Gross profit margin. Gross profit margin measures the profitability of a company's core operations by calculating the percentage of revenue that remains after deducting the cost of goods sold or COGS. It helps assess how effectively a company controls its production costs. Operating profit margin. Operating profit margin focuses on the profitability of a company's operating activities. It indicates how efficiently a company manages its operational expenses and generates profit before considering non-operational items such as taxes and interest. Net profit margin. Net profit margin represents the overall profitability of a company, taking into account all expenses, including taxes, interest, and other non-operating items. How to calculate profit margin. Let's consider a fictional company called Money Opulence Corporation and use its income statement to calculate each type of profit margin. To calculate the gross profit margin, divide the difference between the revenue and the cost of goods sold or COGS by the revenue. Multiplying the result by 100 gives the percentage. In the sample income statement, Money Opulence Corporation had a revenue of $1 million and a COGS of $600,000. By subtracting the COGS from the revenue, we find that the gross profit is $400,000. Dividing this by the revenue and multiplying by 100 gives us a gross profit margin of 40%. To determine the operating profit margin, divide the operating income by the revenue and multiply the result by 100 to express it as a percentage. Using the same example, Money Opulence Corporation's operating income is $200,000, and the revenue is $1 million. Dividing the operating income by the revenue and multiplying by 100 yields a 20% operating profit margin. The net profit margin is calculated by dividing the net income by the revenue and multiplying the result by 100. The Money Opulence Corporation generated a net income of $100,000. Dividing this by their revenue of $1 million and multiplying by 100, we find that the net profit margin is 10%. Why profit margin is important? Profit margin is a vital factor in financial planning and decision-making. It assists businesses in evaluating the financial viability of new projects, investments, or expansions. By considering profit margins, companies can assess the potential impact on overall profitability and make informed choices about resource allocation and strategic initiatives. Another important aspect of profit margin is its role in pricing strategies and cost management. Understanding profit margins enables businesses to set appropriate pricing levels, ensuring that revenues cover costs and that desired profit levels are achieved. Furthermore, monitoring profit margins helps identify areas of cost inefficiency, allowing companies to implement effective cost management strategies. In addition, profit margins are closely scrutinized by investors as they provide insights into a company's ability to generate returns. Higher profit margins indicate a more profitable and potentially sustainable business model, which can attract investors and contribute to market confidence. Conversely, Consistently low or declining profit margins may raise concerns about a company's financial stability and operational efficiency.
If you want to see more of these videos, please leave a like and subscribe to our channel. Also, be sure to leave a comment. We appreciate all comments and feedback from you.
Thank you so much.
That's more than enough to help us grow and sustain our production expenses. See you in our next video.